Welcome to The Explainer. Today, we are tackling a force that impacts your wallet every single day, whether you realize it or not. It's something that quietly eats away at your money. Now, before we dive in, if you find this helpful at any point, please take a moment to subscribe, like, and share. It really helps us create more of these explainers for you. See, it's not a big, dramatic market crash or a single bad investment. Nope, it's more like a slow, silent leak in our financial system. It's the reason you feel like you have to run harder and harder just to stay in the same place. It's invisible, and that's what makes it so powerful. And this is exactly what inflation does. Take a look. $100 that you might have saved back in 1985, well, by 2005, it only had the buying power of about 55 bucks. Fast forward to today, and it's worth even less, around $30. The money didn't just vanish into thin air, its value did. So, what is this invisible force really? Let's get right into it and break it down, because it's a lot more than just seeing higher prices at the supermarket. Okay, in simple terms, when the price level rises, each and every unit of currency, every dollar, every pound, every euro, buys you fewer goods and services. It's not that things are getting more valuable, it's that our money is getting weaker. It's like watering down juice. The more dollars you pour into the system, the less each one is worth. So how do we even measure this? I mean, economists can't track the price of every single thing we buy, right? Of course not. So they use a clever little tool, a basket of goods. This is basically a shopping list of common things that people buy, and they track the average price change of that basket. You probably heard of it. It's called the Consumer Price Index, or CPI. So what's in this basket? Well, it's everything from your rent and groceries to petrol for your car and healthcare costs. As you can see, housing is the big one, making up almost half of it. So when you hear on the news that inflation is up, it just means the total cost of this entire basket went up. Okay, so let's get to the why. Why do prices keep rising? Where does inflation actually come from? Well, there are three main drivers we need to talk about. Economists often call these three causes the inflation triangle. And, each point of the triangle plays a really distinct role in pushing prices up. First up, we've got demand pull. This is the classic one. It's the too much money chasing too few goods scenario. This happens when the overall demand for stuff outstrips the economy's ability to actually produce it, and that pulls prices higher. An increase in the money supply is often the root cause here. Then you've got the flip side, cost push. Now, this isn't about everyone wanting to buy things. This happens when it just costs more for businesses to make things. Think about rising energy prices or those huge supply chain disruptions we've seen that make it way more expensive to create products. And hey, this isn't just theory. The 1970s gave us a perfect, painful example. When oil prices skyrocketed because of embargoes, it dramatically increased production costs for pretty much everything. And that pushed inflation to absolutely historic levels. All right, and the third cause is a bit more psychological. It's called built-in inflation. This is all about what we expect to happen. See, when people expect inflation, they start demanding higher wages to keep up. But then businesses have to raise their prices to cover those higher wage costs, and that creates a self-fulfilling loop, the wage price spiral. So, as you can probably guess, the impact of inflation is not evenly distributed at all. It creates a really clear divide between different groups in the economy. It creates winners, and it creates losers. And this quote right here, it just brilliantly illustrates the core problem for most people. The financial advice we always get, save diligently, can actually become a trap in a world with inflation. So here's the crucial point. If you're just holding cash in a savings account that's earning, say, 1%, but inflation is running at 4%, you are guaranteed to be losing purchasing power. But if you have debt, like a fixed-rate mortgage, inflation actually helps you. Why? Because you're repaying that loan with money that is worth less than when you borrowed it. This is a huge reason why many people invest in assets like real estate and stocks. They tend to rise with inflation. Hey, if you're finding this useful so far and maybe having a light bulb moment or two, it would be amazing if you could help us create more of these by hitting that like and subscribe button. It just takes a second. All right, let's move on to our final section and see how all of this gets managed. Because if it's so powerful, who is actually trying to control it? Well, that tough job usually falls to a country's central bank, like the Federal Reserve in the US. Their main tool is what's called monetary policy. And really, that just means adjusting interest rates. They raise rates to cool things down, and they lower them to stimulate the economy. It's a constant balancing act. Now, here's something that might surprise you. You'd think the goal would be 0% inflation, right? But nope. Today, most economists and central banks actually aim for a low, steady rate of inflation, usually right around 2%, which, of course, leads to a pretty natural question.
Exactly. If inflation is this silent wealth killer, why on earth would we want any of it? Why isn't zero the goal? Well, the thinking is that a small amount of inflation is actually good for the economy. For one, it helps avoid deflation, that's falling prices, which can be even more dangerous. It also gives the labor market a bit of flexibility. And, crucially, it gives central banks room to maneuver by cutting interest rates to fight off a recession. But that balance is incredibly delicate. The period known as the Great Inflation, back when U.S. inflation soared to nearly 15%, was a very painful lesson in what happens when that control is lost. It actually took a severe recession to finally bring prices back down to earth. And all of this leaves us with a final thought to chew on. As our economic system has continued to evolve, with digital currencies and all sorts of new technologies, the very nature of money and value is being questioned. What does this all mean for tomorrow?
Look, at the end of the day, inflation is more than just an economic trend. It's a fundamental rule of the game we're all playing. By understanding it, you can protect your wealth and maybe even make it work for you. You can turn it from a trap into a tool. Thank you so much for joining us on The Explainer, and please don't forget to subscribe.